Well, hello, everyone, and welcome. This is Cynthia Tomaine with Interactive Brokers, and thanks for joining today's webinar. Now, I do want to welcome Robert Green, CPA, as well as CEO of GreenTraderTax.com, for today's presentation. So with that, Robert, thank you for joining us. I want to ask everyone to welcome you. And what I'm going to be doing is moving, let me make sure that I do, here. I can move the controls over to you. What I'm going to do is pass you the controls so that we can go ahead and get underway. Thanks for joining us, Robert.
Thank you, Cynthia. And I'm grabbing the screen. And let me minimize and show the slide presentation. Okay, everyone. Cynthia, do you see my full screen?
It looks great.
Good. All right, let's get started. How non-U.S. persons, residents, so that means if you're a citizen and a permanent resident of the U.S., you're a U.S. resident. What about the rest of the world? Well, in the eyes of the IRS, they're non-residents. So we say non-U.S. residents. Now, the whole world is interested in U.S. stocks and U.S. financial markets, which have been a leader over the years. And they may buy U.S. stocks in their home country, or they may go over to Interactive Brokers and open up a U.S. brokerage account. But they're not a U.S. resident, they're a non-U.S. resident. So what are the implications? There are income tax implications, gift and estate tax implications. And non-residents, non-U.S. residents need to know what they face. It's a little complicated today, but the good news is if you are a non-resident with a U.S. brokerage account, it's maybe seamless for you. The broker will do the withholding, take care of the taxes. You can get a foreign tax credit in your home country. You don't need to file a U.S. return in most cases. And hopefully you won't pass away and have estate tax issues to deal with. So at the end of the day, this can be a fairly simple undertaking. But as we delve into the weeds, you'll see it is complex issues underneath the surface. So I'm the presenter. Here's a recent photo. And those are transition lenses, so it looks like sunglasses. They're not. I'm the CEO of GreenTraderTax, our website, and the managing member of GNM, Green, Neuschwander, and Manning Trader Tax. I'm considered a leading authority on Trader Tax. I wrote the 2018 Trader Tax Guide every year for 20 years. The latest edition deals with the latest Tax Cuts and Jobs Act, which impacts investors, traders, investment managers, and has some impact on non-U.S. residents too. I'm a contributor to Forbes, and you'll see our content in leading brokerage firms like IB, financial media, and more. This information is educational. It's not intended to be a substitute for specific individualized tax, legal, or investment planning advice. If you feel that one of the issues we discussed today has an impact on you and you want to discuss it, you should consult with an expert. Consider our firm for help, but choose any expert you'd like and get the answers you need. Because remember, the broker does their job and you need to do your job. Sometimes they overlap, but sometimes they don't. So sometimes you have responsibilities past what the broker does for you. Now, Robert Green and the Green Companies, I'm not affiliated with Interactive Brokers. I do webinars, tax webinars for them, and there's a whole history of them on their site, and I thank them for that. It works nicely together. I've done some trading academy work as well. So check out that prior content. Now, here's a description for today. Many non-U.S. residents have U.S. brokerage accounts. The U.S. Treasury requires brokers to withhold U.S. taxes on non-U.S. residents, on U.S. dividends, and certain other types of U.S. income. I have to use the word U.S. a lot here. It gets monotonous. But the point is that you're a non-resident for U.S. purposes. You own stock in Apple, General Motors, U.S. companies. They're paying you dividends. And the U.S. is saying, hey, that's source income in the U.S. We want our share of taxes on that. Even if you live in Australia and buy U.S. stocks, there's withholding. So when it comes to U.S. companies, not foreign companies, not bonds and interest, but U.S. companies, there's dividends and there's withholding tax. That's the key issue that the broker deals with. However, there is no withholding on capital gains. That's the great news here, folks. You're trading on your IB account and you're a non-U.S. resident and you're making $100,000. Some lose money, but some make money. And it's good news that because you're not in the U.S. for more than 183 days, you live abroad, you don't have to pay taxes in the U.S. on capital gains. There is no withholding. That's great news. Now, in this webinar, I'm going to explain how the accounts work for non-U.S. residents, ways to save income and estate taxes, how you got to lock in on the tax treaties. That's where you find lower rates, exclusions. Remember, there are general laws for the IRS for everyone worldwide, general rules. But some countries have said, listen, we don't want the general rules. We have this special relationship with the U.S. We're not going to overtax your people when they have accounts in our countries or they do business in our countries, and you don't overtax our people when they do business or have accounts in your countries. They make a deal. It's a negotiation. And so there are income tax treaties and there are separate estate tax treaties. Now, if you do pay U.S. taxes, again, the broker withholds it for you. You may not even notice it. You may think it's fine. You're trading Apple, there's some dividends, they take, 30% or 15%. It's not the end of the day. And then you get a foreign tax credit in your home country because you would have owed the tax there anyway. And you don't have to have double taxation. And we're going to cover other tax planning strategies. So hopefully you're with me so far. Now these are some overview slides, and then we're going to get into the weeds a little further. So U.S. tax withholding on certain passive income in a U.S. or foreign brokerage account, non-U.S. resident individuals or foreign companies, they're subject to U.S. tax withholding. So they have income from U.S. sources, and there's tax withholding, but it's only on U.S. dividends and certain U.S. source passive income. The default tax withholding rate on this passive portfolio income is 30%. So if you don't claim a lower tax treaty rate, it's 30%. Now, income tax treaties between the U.S. and other countries provide for lower rates on passive portfolio income. They also talk about effectively connected income, business income. So if you're running a business here, now running a business here in the U.S. is different from getting passive portfolio income. So the different types of income with different types of withholding issues, with different treaty provisions. Now, a lot of treaties say, hey, you don't have to withhold a 30% IB, withhold a 15% or even less. Now, many non-U.S. residents, they're eligible for the foreign tax credit. So they pay, the broker withholds taxes here, and it's almost like you just withheld the taxes in their home country, because in a sense, they're going to get a credit in their home country. They're not going to pay taxes twice if their home country rate is higher, but their home country rate might be lower. We'll talk more about the foreign tax credit later. It's important and it's a benefit. Now, Americans file a Form 1040 individual income tax return. We just finished the 2017 tax season. The last extension date was October 15th. It's a big undertaking. So when you as a non-U.S. resident open a U.S. brokerage account, are you going to have to file some type of 1040? In this case, a 1040 NR non-resident? The answer is no. in most cases, you're not going to have to file a 1040-NR. The U.S. brokers handle the tax withholding on passive portfolio income. They pay those taxes to the U.S. Treasury. They do a lot of work on your behalf. They report that income to you, and they report the withholding to you on the Form 1042-S. You get the 1042-S, you look at it, you say, thank you very much. What do you have to do with it? Probably nothing. Now, the non-U.S. resident does not have to have an obligation for filing a U.S. tax return 1040-NR if the tax liability of such person was fully satisfied by the withholding of the U.S. tax at the source, and such person was not engaged in a trade or business in the U.S. at any time during the year. So you open your IB account, you filled out the form W8BN correctly, you said what tax treaty you're entitled to, they got the right rate, IB, they withheld at the right rate, you don't owe any taxes, you don't have a business in the U.S., you put that 1042-S in your file and you're good to go. There is no tax filing in the U.S. And then you look to get a foreign tax credit in your home country. So there's a lot of content today, but for most of you folks, it's going to be very simple. I'm not trying to tell you got this big tax compliance headache to deal with. You don't. Now, there may be a case where you want to file a 1040-NR. For example, if you're entitled to a tax refund. Now, why would you be entitled to a tax refund? Well, here's how. A non-U.S. resident should consider the 1040-NR if they are due a tax refund. Such a condition could arise if the U.S. broker withheld the default 30% rate. So you filled out your W8BN, and you said, I'm a foreigner, and they said, okay, and they withheld 30%. But you didn't realize at the time that you were entitled to a lower tax treaty rate. You didn't fill out the second part of the W8BN. Now, you overlooked claiming the tax benefit on the W8BN and when you open the account. So you might think, well, let me just ask the broker now for the refund. Well, a broker is unable to request a refund of tax withholding already paid to the IRS. So there is a mechanism to get the refund. You have to file the 1040-NR refund claim from the IRS, and our CPA firm can help you do that. Now, 1040-NRs can get a little complicated, and we don't want to do them for everyone unless we feel that we know you well enough. So you want to contact us to talk about it. Now, capital gains, that's the big gorilla in the room. You might make $10,000 a year, $5,000 in dividends, but you might make $100,000 in capital gains. The critical point is that capital gains are not taxable in the U.S. if the non-U.S. resident does not spend more than 183 days per year in the U.S. That's half the year. So if you're from Paris, France, or Beijing, China, or Montreal, Canada, and you live in your home country, you just opened up your U.S. brokerage account because it's a better platform, better commissions, and you want to trade U.S. stocks where the action has been, up or down. Today, down. Volatility is good for traders, for some. Anyway, I don't want to get off topic here. The point is, you don't live in the U.S., so you don't have to pay U.S. capital gains taxes. Now, what about students, scholars, employees of foreign governments who happen to come to the U.S.? They're not changing their domicile. They're intending to just get an education or work a short-term assignment in the U.S. Well, there's a special rule. If they intend to reside in the U.S. for longer than 1 year at the time of their arrival, and of course they spend over 183 days, which they're going to do because they're a student at NYU in New York City, and they happen to have a trading account, and a lot of college students do, well, then they're going to have capital gains taxes, just like a U.S. person. Now, it doesn't mean they're filing as a U.S. resident. It just means they're reporting the capital gains on the 1040-NR. U.S. brokers do not withhold taxes on capital gains transactions, only on the certain income that requires it, like the U.S. company dividends. Now let's start digging deeper into the content, and hopefully you're with me so far. Non-U.S. resident, U.S. withholding taxes on U.S. brokerage accounts. You got the withholding, the W-8 form, the 1042-S. We've touched on this already, but we're going to dig a little deeper. So types of passive portfolio income. What is subject to this 30% withholding? Well, you got your non-U.S. residents are subject to the U.S. tax withholding on dividends paid by U.S. companies, payments in lieu of dividends for U.S. companies, and other fixed or determinable annual or periodic, they call it FDOP income. Now, FDOP income is passive income such as interest, dividends, rents, or royalties. Now, dividends paid by foreign companies are not subject to U.S. withholding. So you may have a U.S. brokerage account, but you may have some foreign equities inside that account, and the dividends on that is not subject to U.S. withholding. Now, what about mutual funds? Well, they're generally subject to withholding on U.S. taxable dividend distributions, including short-term capital gains distributions, but not long-term capital gains distributions. Now, this is another big area, interest income. It's exempt. Interest income on bonds and commercial paper issued by U.S. companies, by the U.S. Treasury, by U.S. government agencies. That's generally exempt from U.S. tax withholding. It is reportable on the 1042-S. The broker will tell you about having that income, but they'll show that there was no withholding on it. What if you trade a commodity ETF structured as a publicly traded partnership? You might get an annual Schedule K-1, which goes to all partners, U.S. or non-U.S. The partnership is a pass-through entity. The Schedule K-1 might pass through some capital gains, but that's exempt from withholding. The partnership is a withholding agent, not the U.S. broker. Now, non-U.S. residents, when they open that U.S. brokerage account, you go to the broker and they say, there's two doors to walk through. U.S. residents walk through door 1 and they fill out a W-9 with their social security number. And then there's door 2 for the non-U.S. residents, and they fill out a W-8 showing their certificate of foreign status of beneficial owner of for United States tax withholding. That's what the form is called. And there's different types of W-8 forms, but you're filling out the W-8 to say, hey, I'm a non-resident. So there's withholding, no tax on capital gains. I'm not getting a 1099-B, I'm getting a 1042-S. The broker then switches on their system to say, this is a non-resident. We're going to withhold taxes on the U.S. source dividends and other FDAP income and at the appropriate tax treaty rate. Their systems are set up. They have all these tax treaty rates. You may not know it. You don't have to dig out that rate from a tax treaty. It's kind of complicated. Go to the broker and ask them. They'll tell you what the withholding rate is. And the broker is going to report all that income and the taxes withheld on the 1042-S. So if you're an individual, it's a W-8-BEN. If you're an entity, a foreign entity, it's a W-8-BENE. Now, if you happen to be opening an account related to your U.S. business with effectively connected income, it's a W-8-ECI, foreign government or organization, W-8-EXP, foreign intermediary branch, W-8-IMY. Now, what you do is you just click on a link that I gave you in the handouts, and it takes you to websites where it explains more. Now, the U.S. broker issues that 1042-S. It's a simple one page. I'll show it to you shortly. That's at the end of the year. As a withholding agent, the U.S. broker is required to report all U.S. source passive portfolio income and the related taxes withheld to the IRS and the client on the Form 1042-S. Foreign persons, U.S. source income subject to withholding. So I'm giving you a link to see those instructions, to read more about the withholding, to read more about the FDAP income. The U.S. broker issues a separate 1042-S for each category, so you might get a handful of them. But again, you're probably just going to have to put them in your file to save and not require any action if there's no tax refund. As long as you set it up correctly, you saved yourself the headache later on of having to file a 1040-NR. So you fill out that W-8 correctly with the correct tax treaty benefits. A U.S. resident receives a 1099-B instead of a Form 1042-S. So the 1042-S is a one-pager. The 1099-B might be hundreds of pages if you're trading securities actively for the American resident, U.S. resident. So here's what the 1042-S looks like. You see up top, you see there's an income code, the gross income. It's Chapter 3 or 4 withholding. You put in the amount of income, the amount of withholding, and this is what you're kind of going to need in your home country to get that foreign tax credit. This is proof. This is a government, the broker prepares it, but there's a government filed form showing your income and withholding. This is what you need to give your accountant in your home country. Or if you're filling out a 1040-NR in the U.S. to get a refund here as well. Now, the U.S. passed a big law, the Foreign Account Tax Compliance Act, FATCA. They wanted to pressure countries and banks and brokers around the world to do this type of reporting for Americans, because Americans were hiding money offshore, and they wanted the Swiss banks to report it to the IRS. And so a lot of these foreign countries said, well, listen, if you're going to make us do all this for you, you have to reciprocate and do things for us. So the U.S. broker may file that 1042-S in your home country if it's required based on reciprocation agreements, which vary by country. So when it comes to things that you do with brokers, with money, things worldwide, there's no hiding anymore, even in crypto. The tax man is catching up. So you want to do things right. Let's dig further into the capital gains and losses in that 183-day rule. Let me just drink something. If a non-U.S. resident spends more than 183 days in the U.S. in a given tax year, they owe U.S. taxes on the U.S. source capital gains, even though they may not trigger U.S. residency under the substantial presence test. U.S. residency is triggered with lawfully permanent resident status or by meeting the substantial presence test. Lawfully permanent resident status includes U.S. citizenship, if you happen to be a dual U.S. citizen and citizen of your home country, or having a U.S. permanent resident card, otherwise commonly known as a green card. So if you have legal residence, citizenship or green card, and you don't spend one day in the U.S., tough luck. You're taxed on your worldwide income as U.S. resident. If you don't have citizenship or a green card, then it comes down to the substantial presence test. And so let's take a look at that. If you click on one of the links, this is how it works. It takes you over to a website, and you'll see it could be 31 days in the current year and a combination of how many days in the prior few years, and you add it all up and you get to a number of 183 days. So it's not just the current year. It's a combination of the prior 3 years. So you always want to know, am I a resident or am I a non-resident? Now, here's what happens. We've had clients who they've had their W-8 account with the broker for years, but they drip by drip, they started spending more time in the U.S. and unwittingly, they triggered the substantial presence test. Well, then they really should switch their account over to a U.S. resident account with a W-9 and get an international taxpayer identification number, even if they don't have a social security number. And they have to be treated as an American. So you need to tell your broker what changes in your life so that they act on the proper information. So anyway, if you're a resident with a substantial presence test, even because you spent 50 days, but the combination of days in the prior years triggered it this year, well, you're going to pay taxes on worldwide income, including capital gains. But if you haven't triggered substantial presence, then you just look at that 183-day rule. And if you trigger it, you're going to report the capital gains on the 1040-NR. And then you have to file a 1040-NR because there is no withholding on capital gains. So I know this is a mouthful, folks. Try to stay with me here. Go back, watch the recording, look over the handout, which is the presentation. Consult with us about it or another expert that you're happy with. But you got to figure out these rules on how they apply to you. Now, again, if you're a student, scholar, employee of a foreign government, you still got the 183-day test rule. So when you came here to go to NYU for your undergraduate or graduate program, or Harvard or Yale, wherever it is, and you entered a 3-year or 2-year program, a graduate school program, well, if you're coming for 2 years, it's pretty obvious that you had the intention of being here greater than 1 year on arrival in the U.S. And therefore, the 183-day rule applies to you, and you have to pay capital gains taxes while you're trading during your studies, which a lot of students do. All right, let's talk about the income tax treaties. Treaties can often reduce or eliminate U.S. withholding tax and obligations on a 1040 or otherwise. So if you live in a country that has an income tax treaty with the U.S., you need to look it over. There's a lot of provisions about the personal services income, but there's also the provisions about the passive portfolio income. And you have to let the broker know that you're availing yourself of that treaty, and they switch on they put that in their system, and automatically you qualify for the lower rates in most cases. So the U.S. has income tax treaties with many foreign countries, not all, many. They've been in place for many years. They're rarely updated. For non-U.S. residents, these treaties can often reduce or eliminate U.S. tax on various types of personal services and other income, such as pensions, interest, dividends, royalties, and capital gains. Each income tax treaty must be reviewed to determine whether specific types of income are exempt from U.S. tax or taxed at a reduced rate. Maybe they don't tax cap, say that even though you're here for greater than 183 days, you don't have to pay taxes on capital gains. So you're going to override the regular tax with a treaty provision, but you're not going to have to file the 8833 on, and we'll cover that later. Don't try to figure this all out on your own. Ask your broker for help. Tell them, I'm a resident domiciled in China. I'm in Australia. I'm in Canada, England, France, wherever you are. Ask your U.S. broker what tax treaty rate applies to your U.S. source income. You can find out if there is a treaty. You can just click on the U.S. treaties and go through the whole list. And like if you went to the treaties and you would scroll down, you would see like Austria or Belgium or Canada, like in Canada here, and you'd read this section. A lot of it talks about the personal services. They may not give you the dividend withholding rate, but at least you see there is a treaty, and you can ask your broker for the withholding. They'll identify the types of income you expect to receive. You can tell them, I'm going to trade U.S. stocks and get some dividends. They'll tell you what's subject to withholding tax, what the withholding rate is going to be, depending on the category, and what's going to be exempt. And as a withholding agent, your broker should have these resources readily available to inform you. A company like IB has a sophisticated back office, and they have you covered on this. Foreign tax credits. This is important. Non-U.S. residents might get a credit for U.S. taxes withheld on their home country tax return. So again, yes, you might have to pay some taxes to the U.S. But if you were going to pay taxes in your home country anyway at a same or higher rate, you didn't really increase your global tax. You just split what you pay your home country versus what you pay the U.S. Several countries, including the U.S., tax residents on worldwide income, and/or they allow residents a foreign tax credit, FTC, to avoid double taxation, paying tax on the same income to two countries. So you wouldn't want to pay a 15% withholding tax treaty rate on Apple dividends to the U.S. and then pay another 15% in your home country, when in fact you shouldn't have to pay it more than 15%. You pay it in the U.S. and then you pay zero in your home country. In a sense, the taxpayer's effective tax rate is the higher of the tax rate in their home jurisdiction or the U.S. withholding tax rate. For example, if the home country tax rate is 35% and the U.S. rate is the default 30% without a treaty benefit, then the taxpayer is going to get an FTC, a foreign tax credit, on their home country tax return for the entire amount of U.S. tax withheld. So when they go to pay the tax in their home country, they're going to say, I already paid the U.S., give me a full credit or partial credit, and then I pay the balance or none at all. Foreign tax credit is a great way to get that final relief. Now, we've talked about income tax, and it's probably more complicated than you like, but again, it may be simple for you. What about estate tax, otherwise known as the death tax in the U.S. by people who don't like those rules? So in the U.S. and in many countries, when you pass away, they want to tax your estate. Now, usually there's a step up in basis, and then you don't have to also pay capital gains taxes. Now, what a lot of non-U.S. persons don't comprehend, and they should, is that there are non-U.S. resident domiciliary estate taxes too that are different from the U.S. rules. So there is a U.S. estate for a non-U.S. resident domiciliary. So you live in Australia and you have a U.S. brokerage account and you pass away. So for a non-U.S. resident domiciliary, if the fair market value at death of the decedent's U.S. situated assets exceeds $60,000, there is a U.S. estate tax. So you pass away and you own $100,000 of Apple stock. Whether you hold on to those shares in Australia or whether you have a U.S. brokerage account with those shares, it's considered U.S. situated assets. And you have your exemption of $60,000, and you might owe estate tax on that other $40,000. The rate starts at 18%, and it could rise up to 40% depending on how much is in your estate. A lot of people never knew that. A lot of people may not be compliant on that. There may be exemptions and tax treaties and all sorts of deductions that apply, and you may not owe the tax. But you should know about it and plan around it accordingly. A non-U.S. resident domiciliary is entitled to deductions for funeral and administrative expenses, debts allocated to the U.S. gross estate, donations to U.S. charities, and a marital deduction for property passing to a surviving spouse who happens to be a U.S. resident. You're a non-U.S. resident, but your spouse is a U.S. resident. You get a full spousal deduction. If you're married to a U.S. resident who has a lot of money and he passes or she passes and you're a non-resident, there is no spousal deduction. Estate tax is a whole other set of rules, folks. Now, the 2017 Tax Cut and Jobs Act, the big tax reform bill from last year, it raised the 2018 estate and gift exemption limit for a U.S. domiciliary to over $11 million, $11,180,000 per person, and it's indexed for inflation each year. So if you pass in the U.S., let's say you're single and you're a U.S. resident and you die and your estate is worth $10 million, there is no federal estate tax. There may be some state where you live estate tax. Now, a lot of states have drastically increased their exemptions to catch up with the federal, and some will be on par with the federal by 2020 or 2019, but you got to check the state. But again, so the U.S. rules don't apply to the non-resident. Now, by the way, a U.S. resident domicile estate, that includes worldwide assets. So if you're a non-resident, your estate doesn't include worldwide assets. Don't even think about that. We're just talking about some picayune little assets that qualify in the U.S., like U.S. stocks, not U.S. bonds, not U.S. bank account money. We're talking about U.S. securities. The new tax reform law has not raised that puny $60,000 exemption. It's not indexed for inflation. So it's based on the U.S. situated assets. Now, I don't want to delve too much on the estate stuff because it may not ever hit most of you. I think it's something you need to look in and be cognizant of and plan about and check the treaty on. So I'm going to kind of cover this without putting in too much additional commentary. So some non-residents with U.S. assets must file a U.S. return. You can go right to the IRS website. Deceased non-residents who were not American citizens are subject to U.S. estate taxation with respect to the U.S. situated assets. U.S. situated assets include American real estate. You bought an apartment in New York City. That's in your U.S. estate. That's a big number. Tangible personal property. You have some jewelry here. And securities on U.S. companies. That U.S. brokerage account was securities. If you're trading from China or Australia or France, and you don't feel well, you're getting older and things aren't going good for you, maybe you're going to close the account before you pass so you don't have a U.S. estate tax, or use a trust or a foreign entity or something else. You do a little planning, have a little foresight. A non-resident stock holdings in American companies are subject to estate taxation, even though the non-resident held the certificates abroad or registered the certificates in the name of a nominee. This is right off the IRS website from the link I give you above, folks. And they also go on to say there are some exceptions. Assets that are exempt from U.S. estate tax include securities that generate portfolio interest. I'm not sure what that is. Bank accounts not used in connection with a U.S. trade business, and insurance proceeds. Now, estate tax treaties between U.S. and other countries often provide for more favorable tax treatment to the non-resident by limiting the type of asset considered situated in the U.S. and subject to U.S. estate taxation. Our tax attorney, Roger Lawrence, when I talked to him about this issue, he said there's a tiny number of U.S. estate tax returns for non-residents with brokerage accounts. It's infinitesimal. This is mostly just rules that you should be aware of, but in practice rarely kick in. But that does not mean you should put your head in the sand, and you should know the rules and do proper planning. You always need to know what you get involved with before you do it. So there are 15 estate and gift tax treaties. You just click on the link and you go right over and see which countries have them. And I'm going down the list here. Maybe you'll see yourself on that list. Now, the U.S.-Canada Income Tax Treaty includes the estate tax issues. So you didn't see Canada on the estate treaty list, but their provisions are included in the income tax treaty. They get a $2 million estate exemption instead of $60,000. That's nice. Now, U.S. estate tax treaties, they deal with domicile issues. That varies with income. So for income tax purposes, whether you're a U.S. resident or not is different from a state. So bottom line, if you're not intending to live in the U.S., then you're not entitled to a U.S. estate rules. If you're filing as a non-domiciled person, which could be a lot better for you. But then again, you might like that U.S. resident rule with the $11 million exemption. Hopefully I'm not losing you. We're almost past the estate tax, and then I'm going on to another area of great interest. So stay with me here. So the treaties deal with what is in the estate, what's not, what deductions you can get, what tax credits, how they exchange information. Remember, they're exchanging information, folks. You can't just say, I'm going to hide here, and more. So your residency rules vary for purposes of income tax versus estate tax. For estate treaties, they consider where your residences are, where your businesses are, where your family connections are, voting history, and more. We live in the world is your oyster. People can fly anywhere. Traders move all around the world. They get married to people all around the world. They have successful people have residences in multiple countries. You got to figure out where you're landed, where you're situated, your assets, you personally, your family, your business. Speak to a tax attorney and us about, and our firm about it. We have a great international tax attorney. It is possible for a person to be domiciled for U.S. estate tax in the U.S. and not considered a resident for income tax. It's also possible for a person to be resident in one place, U.S., and have a domicile in another. For estate, or otherwise known as transfer tax purposes, a person is considered a non-resident alien domiciliary of the U.S. if they have no intention of residing here. So if you don't intend to reside in the U.S., you are a non-resident alien domiciliary. You can read that article about it in the Tax Advisor. Now, how does this affect you? There's a lot of wonky rules I just went through, and that's the name of the game when it comes to taxes. But how does it affect you? Well, U.S. brokers are not responsible for U.S. estate tax compliance. Your broker, they'll tell you what the withholding rates are on the income source stuff, but they're not going to tell you anything about estate tax. They're not a law firm. They're not a CPA firm. They're a brokerage firm. Now, that being said, they're going to require you to get estate tax clearance before allowing withdrawals from a brokerage account belonging to a non-U.S. resident domiciliary. So John Smith from Australia had a brokerage account in the U.S., passes away, and his family comes to get the money, and the broker says, hey, we're happy to pay you the money, but we got to see that you got estate tax clearance. So you're not, shortchanging the IRS here. Now, you should consider a will to help with probate of the estate so you don't have to go through some sort of state probate issues. Talk to an expert about it. I'm not an estate tax or estate proceeding expert, but I did get involved with all this content to make the presentation today. We don't have a big non-resident business. We mostly handle Americans. Now, certain types of U.S. or foreign trusts or entity structures, they might be helpful. A lot of sophisticated, wealthy people, they'll set up a foreign trust, a foreign company, open a U.S. brokerage account with that. So if and when they pass, the company didn't pass, they can not have to worry about the estate tax clearance. Some of the bigger brokers might have some of this disclosure on their website. I'll give you an example of Schwab's disclosure. And this is quote unquote off the Schwab site. If title to the account is held in joint tenancy with another person, title will pass automatically to the surviving spouse, although tax clearance will still be required. If title to your account is in the name of a trust, disposition of the assets should be under the terms of the trust instrument. All right. let's talk about U.S. gift tax for non-U.S. residents. Now, a lot of Americans, they're not too worried about gift tax. First of all, they give less than the annual exclusion, which goes up each year. This year it's $15,000. But if they give more, they don't owe gift tax because they're using some of their estate credit. And that credit is $11 million. But it's different for non-residents. The 2018 gift annual exclusion is $15,000 per donee like the U.S. Unlike U.S. residents, non-U.S. resident spouses cannot split gifts. So in the U.S., both the father and mother give Junior, their child, $15,000 each, and then they give each Junior and his spouse $15,000 so they can split gifts. The non-resident can't split gifts. Now, you can gift your non-U.S. domiciled spouse money up to $152,000 a year. So if you're going into hospice care and you got your U.S. brokerage account, and you don't want to sell your Apple stock, you love it. So you gift it to your spouse at $152K a year. Your spouse is much younger. He or she is, in good shape, not facing imminent peril. So there is no marital deduction for gift tax purposes for property transferred to a non-U.S. domiciled spouse. I covered that before. Now, you could make a bunch of gifts. Remember I said you were in hospice care? I take that back. That's not going to work because you need to include gifts of property within 3 years of death in the estate. So you got to do the gifts way before hospice care. So I misspoke there. So that they don't want gifts on your deathbed. So they got the 3-year rule, the clawback. So the gift and estate tax is similar but different. It gets so, this is ridiculous. Not only are the rules confusing, but then the tax treaties can be confusing. So I'm not trying to advise everybody around the world today. You happen to live in X country with X treaty, you read the treaty, you figure it out, end of story. You don't need to master this content for the everyman. But I'm talking to the everyman today because I have people from every country on the call, on the conference, on the webinar. So for purposes of U.S. gift and estate tax, they treat U.S. situated assets differently. I don't know if I want to go through this too much. It will make things even more confusing. Go back and read the slides. This next area is of interest. Let me just drink something and see how we're doing on timing. So hopefully you don't have to deal with the gift and estate stuff. It was just really you're vibrant, you're young, you have your income tax issues. Why would you want to have an entity account? Some non-U.S. residents open U.S. entity accounts. Now, hopefully you're not doing it to hide income from your home country and you're doing it for the proper reasons. When people around the world come to us for our entity formation service and they're non-resident aliens, we don't want to just set up an entity unless we know you well and also feel good about your situation. If we get any sense of trying to cheat on your taxes, we're not going to work with you in your home country. So why would you want a U.S. entity? Well, some U.S. brokers are not set up to accommodate non-U.S. residents or foreign corporations, partnerships, or trusts. That U.S. broker might recommend, hey, why don't you just open up an LLC in Delaware, Singlemember LLC, it's the U.S. entity. Then you go ahead and open up a U.S. entity account. It's not a non-U.S. resident account. And we don't have to do all the withholding and issues. We'll treat you like an American. So the broker is going to treat it as a U.S. entity account in some cases, just like any U.S. entity. It's not going to be subject to tax withholding on dividends or other passive income. However, the non-U.S. resident owners of this U.S. entity do not avoid U.S. tax withholding on passive and portfolio income. However, the U.S. owners may get estate tax relief. So Why would you want to open up a U.S. entity account if you're a non-resident alien individual? Well, one reason may be to avoid that whole mess about the estate and gift tax stuff, because the account's not in your name as an individual, it's in the name of an entity. You're not going to bypass the withholding. The broker won't have to do the withholding, but you're going to have to do withholding on yourself, which is more work, more fees, but not that difficult. But then you might get some U.S. estate tax relief. Plus, with some brokers, that's your only option. So there are forms W-9 and 1099-B. When you open a U.S. entity account, the broker requires a form W-9. They're asking for your taxpayer identification number. That U.S. entities file and get that with the IRS. The U.S. broker should issue an annual Form 1099-B, and that's going to report dividends, interest, sale proceeds, cost basis, and other items of income or loss to the IRS and to the taxpayer. Now, is it easier with a single member LLC, or are there complications? Well, there are complications. A single member LLC, so you go to Delaware, you set up an LLC, and you're just you, the owner. Under U.S. law, a single member LLC is a disregarded entity. It's a tax nothing. So that means that the owner of the LLC, you, the foreign individual, need to report the activity on a tax return, an individual tax return. That can get complicated, folks. I'm not recommending that route. I'm recommending a partnership, because here's the problem with the single member LLC. Now, normally for a U.S. resident, the single member LLC can file a timely election to be an S Corp or a C Corp. You don't want to be a C Corp. They're unattractive to traders. It's double taxation. That's beyond the scope of today's content. So our American resident clients, they go with the S Corp. But the IRS does not permit non-U.S. residents to be an owner of an S Corp. That's one of the limitations of S Corps. So if you have a spouse, I'm recommending your spouse be a member so you have a partnership return. But you can't have a partnership unless there are two or more partners. If you're a single member LLC, you can't file as a partnership. So here's the problem. Your SMLLC is owned by a non-U.S. resident. You're a disregarded entity. So it should file a W-8 BEN with the broker. So by filing a W-9, it's not really correct. The broker should really ask you for a W-8 BN, and then you're back to where you were to start. You're back as an individual non-resident. For some reason, if the broker accepts the W-9 to treat it as a U.S. entity, the broker won't do the tax withholding, and it will issue the 1099-B. Okay. What does that mean for you? Well, that leads to a complicated Form 1040-NR, because the individual owner of the single member LLC owes taxes on U.S. dividends and other U.S. source passive or portfolio income. So it's as if you had this non-resident account, the broker did no withholding, and you owe the IRS all those taxes that weren't withheld, so you have to file a 1040-NR, and that NR deals with all sorts of other issues, and it can cost a pretty penny, and our firm won't prepare it for you unless we feel very comfortable with who you are and that you're not cheating on your home country taxes. So what you thought was a shortcut could actually end up being complicated and problematic. A better approach is to set up a spousal LLC, treat it as a U.S. partnership, file your W-9, get your 1099-B, file a Form 1065. Now, understand that your LLC partnership takes over the role as a tax withholding agent from the broker, and the U.S. partnership must issue the 1042-S to the non-resident owner. So you're still going to get a 1042-S, but you're going to get it from your own LLC partnership, which was the agent. So you're not avoiding the withholding taxes, but you're likely avoiding the estate taxes. So here are some tips for preparing your 1065. It can be very straightforward, providing all the owners are non-U.S. residents. The partnership can just say zero capital gains and losses, reconcile to the 1099-B, omit expenses, it has no effect. In the tax return footnotes, you say the partnership has non-resident owners only. They don't owe capital gains taxes because they weren't here over 183 days. And we handled the withholding right. Now, the partnership can allocate dividends and portfolio income to the partners on the last day of the year and then make the tax deposits for withholding, which can wait until January. It's one accounting period that reduces the stress on making tax payments on a timely basis to avoid penalties. So you can make this work. It's more work for you, but it might give you access to a U.S. brokerage account that you wouldn't otherwise get access to, and it can likely exclude you from the estate tax. Is it for everybody? No. Is it for some people? Yes. Now, you're not done. There might be challenges for establishing an LLC bank account. So your broker account pays your bank account, and then you tell the bank, okay, send the money back to me in Australia, and they may balk. So you want to work out all the kinks before you do this setup. You want to make sure it's going to work for you. Consult with me about it or someone else, and then make sure it's going to work with the broker and the bank and that you're comfortable with it. So again, your partnership is the agent for tax withholding. So our tax attorney said the following, Roger Lawrence. The Chapter 3 withholding regulations on U.S. source payments to foreign persons by brokers make clear that there is no U.S. withholding on payments to U.S. persons, which includes a partnership formed under U.S. law. The partnership is the withholding agent, and it is required to withhold on U.S. source dividends allocable to the non-U.S. partners. The U.S. partnership is not engaged in a trade or business in the U.S. with effectively connected income if it's just a trading company. It's an investment partnership with FDAP and a Section 864 exemption. So this is what you're putting in the footnote. Now, when it comes to the estate tax, although not free from doubt, the better view is that it is not included in a U.S. estate of a non-resident alien owner. And that's because intangible assets, like partnership interests, are situated where the owner resides and dies. Legal situs is where the owner is located on death. So you live in Australia, you die in Australia, you own a U.S. partnership. Your U.S. partnership legal situs is in Australia, not in the U.S. Presto, no U.S. estate tax on that account. So here are some other resources, folks. There was a lot of stuff today in the weeds. Re-listen to the recording. Go to the Interactive Brokers website. They have a lot of links about this information. Go to Deloitte, one of the big four firms. They talked about the estate and gift tax. Tax Advisor talked about some of these issues. Struck, the law firm, talked about some of these issues. I talked about these issues on our blog post. Why did I go through the weeds today? Well, a lot of you on the call are CPAs and tax attorneys yourself. A lot of you are very sophisticated people who can follow these concepts. Bottom line, you don't have to follow it all. You're a non-resident. You come to IB. You open up a non-resident account. They do your withholding. You don't owe any taxes. You gave them the right treaty. You got your 1042. You got your foreign tax credit in your home country. You didn't have any taxes to file in the U.S. You don't die in the U.S. You got no worries. Or you don't die soon with these U.S. assets, in the brokerage account. And if you do, you know that you read the treaty. There are exemptions. So you're not worried about it. Don't get up in arms about this, folks. It's probably a nothing burger here. But I didn't want to shortchange respect for the law, and I did get in the weeds today because we haven't really covered this type of content in the past. So closing remarks, come over to the website, give us a call. The 2017 tax season has ended. We're doing 2018 tax planning now. My next webinar on November 7th for IB is going to be on year-end tax planning. That's going to be for everyone. For all back on your U.S. residents, where our main focus is. You have a question about today's content? I'm going to answer some shortly on the webinar, but then when we stop, send your questions over to info@GreenTraderTax.com. So let's go over back to the website now, and you can see things there, and let's go over to your questions. And see on the timing. So we did great on the content part. We did the 1 hour, and now we're going to answer some questions for about 15 minutes. I might not have all the answers because this is not my bread and butter area. You know, IB told me that they have a lot of clients that are non-resident, non-U.S. persons in the U.S., and they were interested in this content. So I tackled it, and I hope that it's useful to those people, clients of IB. So let's take a look at questions. And IB has excellent content on their site and has covered these issues over the years with their excellent people. And I'm just trying to add my 2 cents to it as well. So let's look at questions. So get your questions on the board. There may not be a lot. There's not as big a turnout today because, again, most of our clients are U.S. residents. So I'm just spreading out the questions here. Francis, does it apply to green card holders living abroad? No, Francis. If you have a green card, you're a U.S. resident taxed on worldwide income. You're not a non-U.S. resident. You're a U.S. resident taxed on worldwide income. So today's content does not apply to you, but could apply to your spouse. So if you were to open up a joint account with a spouse who was a non-U.S. resident, there could be implications. It can get very confusing when there's marriages between residents and non-residents. Mike L., how about if I'm a U.S. expat living in Ireland? Okay, you're a U.S. resident living abroad. So you come over to our website. Let me move over the questions here. You click on Tax Center. You scroll down to International Tax Matters. And you see that we have content for U.S. resident traders living abroad, U.S. resident traders with international brokerage accounts. So you may have an IB account and trade stocks worldwide. And then you may have foreign accounts you need to report. We have U.S. traders moving to Puerto Rico, renouncing U.S. citizenship or surrendering a green card. And then we have non-resident aliens opening U.S. brokerage accounts. We have foreign partners. So we have content for all this international situation. So read that. It's a chapter in our guide as well. And now adding to that content, we're talking about the non-U.S. person brokerage accounts. So Mike, you are an expat living abroad. You might want to have an S Corp. You may want to pay yourself compensation to unlock the foreign earned income exclusion. So that's a whole other area of planning. And we'll have more, maybe we'll do a webinar for you all with IB in the coming year. So Mohammed A., UK trading crude S&P. Well, I don't know whether you're a resident or non-resident, so you got to clarify your question there, Mohammed. Francis again, does this CGT benefit for non-residents apply to short-term gains? Well, if you're trading options, it's capital gains, so it's a 183-day rule. So whatever you're trading, and with capital gains, it's a 183-day rule. And that should apply to 475 ordinary income as well if it's not capital gains, as long as it's not business and it's passive portfolio. So you can always check with me about that. Mark S. Can you be a resident of the U.S. and domicile in a country that doesn't tax outside income? and still take advantage of these rules. Yes. Again, you may live in a country that doesn't tax income that you have in the U.S., but then you're not going to get a foreign tax credit because there is no double taxation. So all the U.S. cares about is the default rules and what the treaty says if you avail yourself of a treaty. And normally if there's a treaty, it might look into the issues you're implying in your question. So you have to see what's happening to you in the U.S., what's happening to you in your home country with this U.S. brokerage account. You need to know that. And don't hide. Don't try to do it for hiding. You want to make sure that your home country knows about what you're doing and that it's legal to do it. Some countries may have capital controls where it's not legal. I'm not telling you what to do in your home country. Neither is IB or any other broker. You need to be responsible for following the rules of your home country and doing what's legal and appropriate and plan tax-wise accordingly. Mark L., could any foreigners who do not live in the U.S. and have no ties to the U.S. trade the U.S. stock market? Yes, that's exactly what's going on. The whole world is interested in U.S. markets. They're big. There's volatility. They've trended up. They've been great for buying and holding over the past 10 years. That, of course, could change overnight. So I'm not giving investment advice. And I'm not suggesting people should do this. And there are risks with brokerage accounts. But the whole idea is that if in your home country you work, now come over to our website. And remember I said there was a blog post about the U.S. the non-resident aliens. So read my blog post, different from the content today. I actually wrote this before the slides, which slides are more in depth. But at the bottom, look, I had 4 ways non-residents trade U.S. markets. The first one was they just went to their foreign broker in Australia or China and they said, can you offer me U.S. stocks? And they still had withholding issues, but there was no 1042 and there still may be U.S. considerations. Then they worked with a U.S. broker affiliate in their home country. IB has affiliates around the world in some places. Or finally, they just went to IB US and had their account. Or they set up the entity. So go back and read this blog post. Zaid A. Are U.S. estate taxes relevant only to U.S. domiciled companies? No, it's the opposite. It's relevant. You are dying and you have U.S. situated assets and you have that $60,000 exemption or better treaty exemption and you have to deal with it. So if the shares are a foreign domicile, so if you open up a U.S. partnership or a foreign partnership or trust, then you personally are not the owner of that account and there's no estate tax issues. So I think I answered your question. It was a little longer than that. You can always follow up with me again. Namit M. Can you talk about the MLP ownership for non-residents? Well, that's a pass-through entity like the commodity ETF, which is the publicly traded partnership. So the broker wouldn't do the withholding, the MLP would. I would have to take another little bit of a closer look at that, so I don't want to speak out of school on that. Sarah J. Do non-U.S. residents have the option of having spot Forex taxes, capital gains? Well, I think if it's 988 income, it should be exempt because it's passive portfolio. It's not U.S. dividends. But yeah, they probably could make a capital gains election. I'd have to look into it, but I don't think they have to. I think the 988 ordinary income should be considered passive portfolio, but I'd have to delve a little bit more to be 100% sure. So I said I was going to answer questions today, but they're off the top of my head. And again, I'm not a pro in this area. This is something a little bit new for me to delve into the weeds here, but I'm giving you some common sense answers, but follow up with us on it. Jan L. I'm only giving first initials for the last name to protect anonymity. My niece, a Chinese citizen, is studying in high school in the U.S. I am paying her tuition of $20,000 a year. Do I have to include this in my tax return? Well, you didn't say whether you were a resident or not, and if she's, so that's another issue. But you know, if you give your niece money and you trade for her in the U.S. and she's in the U.S. to go through high school for more than a year, she's going to have capital gains taxes on her 1040 NR. So plan this stuff out carefully, folks. Yan had another question. By the way, I'm a green card holder. Yeah, so you're filing as a resident. So yeah, you want to follow U.S. rules for dealing with gifts, paying for education. Look into the 529 plans. Those are expanded. They cover all sorts of education now, not just higher education. So follow up with us, Yan. We work with clients with all these issues worldwide. We know international tax. We know these issues because a lot of our clients are investors, they're traders. They have issues that are worldwide. And there's so many people that have come into the U.S. from around the world to work for U.S. companies, foreign companies in the U.S. And they've done great. They've gotten green cards. And now they want to go on to be traders and they want to make more money. And we're flooded with those types of clients. We love to work with you. We think it's fantastic. So we can help you. JPP, can the partnership be a green card holder? No. But you can have a Delaware LLC. That's the whole point. It's got its legal status. You formed an entity. The U.S. used to be known as a tax shelter years ago. It's unfortunately been used for money laundering too, where people around the world have set up these Delaware LLCs and bought apartments, and people haven't had to look behind the ownership until President Obama changed the rules, and now you need to know the beneficial owners. When it comes to tax cheating and those types of games, we have zero tolerance as a firm. We're very ethical. We have great content for you to do things legally. Why would you want to be a crook and get busted? The IRS is catching up with all this stuff. There's reporting everywhere. It doesn't pay to be a crook. Now, it's unfortunate to read about people who are crooks who get away with it. That's disheartening. I encourage you to do things properly. There's plenty of great things you can do properly. It's not good enough to say, oh, I didn't know the law. Our clients know the law. We educate them. Kenneth K., if you're not a resident or domiciled in the U.S. and die owning foreign securities, well, you're good with your foreign securities. Those are not U.S. situated. It's only the U.S. securities. ARC L. Not a question, just a note. Fidelity does not even allow you to trade if you become a 9. Yeah, some brokers don't want to touch this with a 10-foot pole. Every broker is different. Every broker's compliance department is different. There are some smaller brokers who say, listen, we don't want to we can't help you. We don't take a W-8. Set up the Singlemember LLC, then we could take you. And then those clients find their way to us and they ask about it. And it could work, but better with the Spousal LLC. So every broker is different. Mohammed A., non-resident. Oh, I forgot your original question there, Mohammed. But if you're a non-resident and you're trading all this foreign stuff, it's not U.S. withholding. The withholding is on the U.S. source dividends, payments in lieu of dividends. So it's a very limited list. And you would know it because the broker would be withholding it. Lionel I. How do I need an accountant if I set up a spousal partnership to pay the withholding tax myself? You may not need an accountant. We always help people with our content to do self-help, to do self-preparation. You may want to consult with me about it, but if you set up the U.S. LLC partnership, you do the withholding tax, you file the 1065 in a simple way that we said, you issue the 1042S. You can do it all yourself. It's not that hard. You may just need to consult me about it. You may not need just consult this content. Hugo T. Great webinar. Thanks so much. Holding emerging markets corporate bond ETF. Well, that doesn't sound like U.S. withholding tax to me because it's not. And again, ask IB about it. Ask your other broker about it. Half of you on this call may be IB clients. The other half are clients with all sorts of other brokers. So, because we both invited our clients to the call. to the webinar. Leandro V, could you please explain a bit more about withholding taxes on non-resident alien bonds? There is none because it's reportable on the 1042, but it's exempt from the withholding on income tax because it's interest income. So go back and look at the slides. Surge C or ADRs from non-U.S. companies trading. No, that's not. It's U.S. situated assets. It's not your foreign securities. It would be extremely unfair for the U.S. government to say, well, just because you opened up your U.S. brokerage account with IB or another broker, then now we're going to tax everything. No, that's got nothing to do with it. If you held those securities in Australia, it's a question of what assets you own, not who the intermediary broker is. Zaid, again, better with an example, non-resident buying LLC. Well, again, these are not U.S. situated assets. They're foreign situated assets. So you open your IB account. I keep using IB as an example. Why not? Because half the people here are from IB. They give you access to the world. So you got all these securities from around the world. Those are not U.S. situated securities. Don't worry about those for withholding of income or estate tax. And then coming to the final questions, and we're going to wrap up. So I think I got all the questions. So folks, come back over to the website. If you want to do a consultation with me, go over to services, click consulting. If you want to have an entity, do a consultation first. We may or may not agree to do our entity formation service for you. Come over, click on contact us, send us over a web form or an email with your questions that you didn't get into the session today. And I want to thank IB very much for hosting the webinar today. And thank you all for coming. Please share the content and come to our next event, November 7th on year-end planning. Thank you, everyone. Back to you, Cynthia.
Well, Robert, thank you so much. A lot of terrific information you've covered here today. And I want to remind everyone, we have been recording today's session, and each of you will get a direct link to today's recorded playback along with the notes or the slides that Robert has been using today. So simply watch your email for those links later on this afternoon. By the way, this will also be listed on the Interactive Brokers website underneath the education menu. There's a webinar section where you can come in and find previously recorded sessions. Not only this one for Robert will be listed there, but also the additional ones that he's already done for us this year. So I did want to point that out. You can always sort or filter by presenter and find all of the different topics that Robert has covered. By the way, as he's mentioned, we're setting up a webinar for November 7th on year-end tax planning, so make sure you check our website as well for that upcoming information. So with that, we're going to conclude today's session. Once again, thanks to Robert Green for today's presentation, and I also want to thank all of you for spending time with us here this afternoon. So this is going to conclude our session here today. You can all exit using the X in the upper right-hand corner of your screen. Thanks, everyone. Have a great rest of your day, and we'll see you next time. Have a good one, all, and thank you.